Dividend growth investors, bonjour, Mike Hiru here. I hope you're doing well today. One of the point of dividend investing is to get that income, right? And I know that a lot of you focus on high yielders. And I don't want you to get dividend cuts in your portfolio because there's nothing worse than a cut. You lose income, you lose capital, and you lose faith in the market. So there are ways to avoid those dividend cutters among high yielders. They're not all bad, they're not all good, but there's a reason. Let's be honest. There is a reason why a stock offers you a yield above 5%, and most of the time it's because there are some risks. So today I'm going to offer you my 5-point dividend safe checklist so you can review each of your stock in your portfolio step by step in 5 points and make sure that you keep on getting those high dividends. All right, so let's get started with point number 1. As the company increased its dividend in the past 5 years? It sounds like a simple question, right? And a lot of investors will tell me, but Mike, I don't care if it doesn't increase its dividend. It pays a high yield. I'm happy with that. Well, first, there's a problem with that because inflation keeps on ramping up. So your buying power is getting down. So year after year, you suffer a passive dividend cut. So that's the first thing. The second problem is, if the company has not been able to increase its dividend over the past 5 years during a super strong bull market where the economy is growing and everything seems to be rolling, there's a big problem, and probably the next step will look like healthcare properties. So Northwest Healthcare Properties didn't increase its dividend for several years. And then what happened? Well, it eventually cut it. So it is one of the warning signs. It's not enough to get rid of a stock, but it's definitely a warning sign that yes, A, you suffer from a passive dividend cut due to inflation, and B, there's a sign that the business is not doing that well. So if you want to avoid those things, well, you have to dig a little bit deeper. Step number 2. Is the dividend growth trend is steady or slowing down? So to make the comparison here, I decided to select Enbridge and BCE. So the difference between Enbridge and BCE is quite obvious. One has been able to increase its dividend steadily, about 3% every single time for several years. And the other one is showing you signs of problems. So it used to be able to increase its dividend by 5%, and then it came to 3%, and then it came to 0 right before announcing the dividend cut. So you can see that when the dividend growth trend is slowing down, it's another sign that the business is struggling. Basically, management is telling you, we cannot afford to increase our dividend. Well, why can't you afford it? Well, because our business is struggling. That's the only answer there is. So when you see a high yield with no dividend in growth or no dividend increases or slowing down, this is a big red flag. That brings us to point number 3. Point number 3, quite simple. How are the payout ratios? Is it above 100%? What's the trend? What's going on with that? So let's take a look at Dow that recently cut their dividend in 2025. So as you can see, Dow offered a high yield, no dividend growth for a while, and then eventually the payout ratio started to cramp up. So it was a little bit higher and higher and higher, and comes the dividend cut. Well, the payout ratio is based on the ratio between the dividend payment divided by the earnings per share. So when you see that the more profit you allocate to pay the dividend, well, it means that you have less profit to do anything else, to grow the business, to make acquisition, to develop the markets that you want to develop. So you have less cash because you're taking all your money and you're giving it to shareholders. That's not a sound way to manage your business. So, all right, so far we have reviewed the dividend increase, the dividend growth trend, the payout ratio. If you want to buy thriving businesses, I have the perfect list for you. I've developed the Rockstar list where I focus on the dividend triangle. We're going to talk about that in a second, where only companies that shows growing revenue, growing earnings, and growing dividend will be part of that list. It covers the Canadian and the US market, and if you subscribe to the newsletter to receive it, it will be updated monthly. So go at dividendstocksrock.com/rockstar and you'll be able to download the first edition, and then every month you'll get a fresh new Dividend Rockstar list with brand new metrics. All right, so let's move to point number 4. Is there an explanation for the high payout ratio? Yes, you can invest in a stock that has a high yield, but keeps on increasing its dividend despite having a crazy payout ratio. Because there is an explanation. There are several ways to calculate payout ratios, and it's based on several different financial metrics. It's important to understand the business model of the company and how it calculates the payout ratio before you make a move. So let's take an example with Enbridge. So Enbridge has been a high yielder for several years. 30 years of consecutive dividend increases. That's quite a feat, especially in Canada. And yet, current payout ratio is 130% and cash payout ratio at 150%. So there's definitely something wrong, right? You cannot give away more money than you're making profit year after year, and continuously you're going to just burn down the business. Well, here's the thing. Enbridge is not using the classic payout ratio based on accounting principles. It's not using the cash payout ratio because it's a capital-intensive business, spending more cash flow than it generates right now because it uses leverage to build a stronger business. So it actually used the distributable cash flow payout ratio. So here's an example of how they explain it in their investors presentation that you can find for each quarter. So as you can see, the dividend for that quarter was like 94 cents. The adjusted earnings per share was $1.03. So a payout ratio of 91% for that quarter. So already pretty high. But when you look at the DCF per share, it's at $1.73 for a payout ratio of 54.5. So a lot lower. And that explains how Enbridge is actually able to make those juicy dividend payments in your account, increasing them every year, and doing that for the past 30 years without missing an increase. Because the payout ratio that you have to use for this one is the DCF payout ratio and not the classic calculation. So finally, last point that is very important now that you have looked at the dividend trend, the payout ratio, and how to calculate the right payout ratio is to ask yourself, is the business growing or struggling? And a lot of high yielders will unfortunately fall in the second category. How can you make the difference between a good business and a bad business? Well, take a look at the dividend triangle. So the dividend triangle is a concept that I've developed at Dividend Stocks Rock to make my analysis a lot easier. It's actually just 3 fundamental metrics that I look for the past 5 and 10 years, and I analyze those trends. So we're talking about revenue growth, earnings per share growth, and dividend growth. When you think about that as an investor, you want to invest in companies that find ways to increase their sales and increase their revenue. And once they do that, you want companies that are able to make it profitable, so increasing their profit, therefore earnings per share. And finally, a company that is able to share the wealth with shareholders by increasing the dividend every single year. Super easy concept, but that tells you a lot about the business. So here's an example of a good dividend triangle for high yielder, Canadian Natural Resources. As you can see, this business is cyclical. It will be affected by the oil barrel. I've covered that several times on the channel. And if you have not done so, make sure that you subscribe to the channel to not miss my videos. And then for CNQ, you see that the revenue is kind of like stable over the past few years. Same thing with earnings, mostly driven by a weaker commodity prices. In the meantime, the business is still able to increase its dividend because the payout ratio is low, and you know that management is very strong. If you know the business, you'll know that it can go through this kind of cycle without any problems. So having a high yielders with a dividend triangle that shows not weak metrics, but sometimes revenue and earnings are going to take a pause in their growth. That totally makes sense. And that is also one of the reasons why the yield is a little bit higher. But if you look at BCE now, where you see that the revenue were not even growing, but the problem here is really the earnings per share. As the revenue were stagnating, the earnings per share kept on going down and down and down. That is a major sign that you should go do a deep dive into their financial statements and figure out what happened. If you did, or if you had followed Dividend Stocks Rock where we did it for you, well, we made a parallel with the earnings per share going down and the higher interest charges in their balance sheet. The problem is interest charges kept on going up because the debt kept on going up and interest rate kept on going up for a while. Now interest rates are a little bit slowed down, but still the problem remains. If you are not able to grow your revenue and now your interest charges are higher, well, you're getting stuck, especially for a company that is capital intensive and requires a lot of cash flow to be reinvested in their business to grow and finally gain market shares. So that explains why BCE had no other choice but to cut their dividend. But as you can see, if you had went through the 5-point dividend checklist, you would have identified this one as a quite dangerous stock to hold. So in summary, let's put them all together. So the first thing is, as the company increased its dividend in the past 5 years. So for Bell, it was yes. Is the dividend growth trend steady or slowing down? Well, in this case, it was quite obvious that it was slowing down from 5 to 3 to 3 to 0 before the dividend cut. Finally, point number 3. How the payout ratio? Well, the payout ratio for Bell kept on increasing as the earnings per share declined. So that is definitely another sign that there's a problem. Number 4, is there an explanation for high payout ratio? Well, in this case for BC, we had the explanation where the margins were hurt because the company was not able to grow their revenue, but saw their expenses going up, especially because of interest charges. And finally, is the business growing or struggling? Well, this one was screaming struggles. So as you can see, when you look at the 5-point dividend safe list, you will quickly identify the high yielders that will continue to pay you in your portfolio and the one that you probably should get rid of. So all right, that's enough for today. If you're looking for thriving companies, once again, you can subscribe to dividendstocksrock.com/rockstar to receive the Rockstar list for free every single month. And until the next video, don't forget to stay invested.